Welcome to our April economic outlook. It's been a very good first quarter, particularly for equities, but even for global GDP, where we saw a marked acceleration in US growth, could well print near 4% annualised for the first quarter. Emerging markets have performed well, led by China. The best that can be said about Europe is it's done not as badly as in the fourth quarter. We're still expecting a contraction in the first quarter, and the UK is looking roughly flat. Recent cold weather hasn't helped to lift activity. So what about prospects for the second quarter? Well, we think growth is unlikely to strengthen further from the decent rate that we experienced in Q1, but we think a maintaining of the current growth rate is entirely possible. Again, driven by the emerging markets, we expect China to deliver around about an 8% annualised growth pace, and the US not going to do as well as in the first quarter, but still should show some growth. In particular, the consumer in the US showed extraordinary strength, really, given the squeeze on our incomes from the increase in taxes. So some softening of consumption is likely. The US housing market remains strong. We think business investment will stay robust. The government's going to begin to be a drag on the US economy going forward. It looks like the so-called sequester, these are the automatic spending cuts, are going to come into effect. The impact gradually ratchets up as you go through the course of the summer. So that'll impart some drag on growth. We do feel that underlying private sector demand is sufficiently robust to maintain reasonable growth through the course of the rest of the year. Now let's turn to Europe, where things were beginning to improve, and then we ran into the Cyprus debacle, the bungled confiscation of Cypriot deposits. Now, Cyprus itself is a very, very small share of the European economy. Even though Cyprus will have a very deep recession, that won't have much impact on the aggregate numbers. The problem is about confidence and precedence. Does the fact that depositors have lost money in Cyprus begin to affect the behaviour of people living in Spain and Italy? So this will be a key variable to watch. If we witness an acceleration of deposit withdrawals from those countries, that then feeds back into the banking system, further undermining their capital positioning, could deliver another tightening of credit conditions and further delaying the recovery. So I think at the margin we're slightly more concerned about European prospects going into the second quarter. We're not looking for big contagion, but it's something to keep a close eye on and could prevent growth from beginning to gain traction as we go through the course of the year. We should also talk about Japan. We've had extraordinary policy announcements at the beginning of April, a doubling of the size of quantitative easing. The Bank of Japan are now going to buy longer dated assets. They're really showing a firm commitment to try and generate inflation for the first time in almost 20 years. The markets have reacted quite positively to this news. We've seen Japanese equities rally, Japanese bond prices also go up, so their yields have fallen, making it cheaper for government to borrow, and also that should reduce borrowing costs throughout the economy. And on top of that, the yen has weakened, so that's providing a nice lift to Japanese exporters. It remains to be seen how sustained this bounce will be, but I think in the short run we will see some better numbers coming out of Japan. Certainly confidence does appear to have improved. And then turning finally to the UK, well, I think at the margin there are some tentative signs of thawing in the credit markets, if not the weather at the moment. The housing market will receive another lift from the budget, programmes to try and encourage home buying. Again, we question whether this is a good long-term policy, because the real problem in the UK is lack of supply of housing rather than demand. But at least over the next couple of quarters or so, we do think mortgage demand will pick up. That should help to stabilise house prices and provide some boost to consumer confidence. Also, providing the European crisis doesn't escalate, the hit to UK exports should begin to fade as we go through the course of the year, buoyed also by an improving global backdrop. So we are looking for some pickup in growth in the UK, unlikely to exceed a 1 to 1.5% pace, but should be well away from the fears of double, triple, quadruple dip recessions we've heard in recent weeks.